Hello traders, today's video I'm going to show you guys how to make money with move contracts. These are not FTX move contracts, these are the Delta Exchange move contracts that have their own quirks and inefficiencies that I'm going to reveal all the alpha to you guys today. So one really good strategy that you can do with this is to get a very uneven risk reward in our favor. So what if I told you that Bitcoin's trending, rising a lot or falling a lot, but you can do something where if price goes against you, you barely get hurt, but if price goes in your favor, you make a fair amount of money. You'd want that, right? I sound like a used car salesman. Well, you can get that under certain market circumstances. I'm going to show you guys how to do that. The current implied volatility of this move contract is very low. It's about 14% rounded. And you only want to do this strategy when the implied volatility is low. Don't forget that. So let me show you guys exactly what to do here. But first of all, I want to explain what a move contract is. So what a move contract is it's a combined call and a put at a certain strike price. The strike price here is 16,500. What that means is that at the time of settlement, if the price of Bitcoin is 16,800, this move contract would expire to a price of $300. You can go long or you can go short this contract at the current market prices. When you do enter this contract, I think it's typically better to use a limit order in between these two prices instead of just buying the ask or just selling the bid. It's probably better to put a limit order out in between those two prices around where the market price is. Okay? Now let's talk about how you can make a fair amount of money from this. This morning at about, what was it? 1450. At about the time of 1450, price tanked. The underlying price of Bitcoin tanked. Let's say that you are right here and you incorrectly believe that price is going to continue going lower, but you're a little bit scared. You're thinking, if I short here, I could really be hurt. What do I do? Well, if you had bought the move contract, you could have potentially made a lot of money and really not even lost that much money because this contract is priced the way it is. Here's how. So if you look here, let's say that you decide to short right here when it was 1453. And the price of Bitcoin was, let's say, 16,390. Okay, so you're going to short right there. Now let's go look at what the price of the move contract was at 1453. And then I'm going to show you guys how you can use this to make money. So the current price of the move contract at 1453 that you would have bought would have been about $130. What does that mean? That means that you would need price to expire below 16,370 to make money. Because if you buy the move contract at 130 and the strike price is 16,500, that means you need the price to either expire below 16,370 or above 16,630. The way I got that number was adding the price that you long or short at to the strike price to see what your break evens would be. Okay? So you would need the price to go below 16,370. But the price right here was 16,390. What does that mean? That means that technically you're shorting at a price $20 lower, which you might say, well, why would you want to do that? If you want to be bearish, why would you want to short $20 lower? Well, there's a massive benefit. Price has gone up $200 since that point. But look what's happened to this move contract. If you had bought this thing at $130, the current price of the move contract is about $100. That means that you would only be down $30 despite the fact that price is up $200. If you had shorted, you would be minus $200. Not only that, but because price spiked up, you could have even bought at 130 and potentially made some money if you had sold at about 170. So it would have even been potential there. However, that's kind of just hoping. I want to show you guys a more tried and tested strategy that works with this. So one thing that I like to do is if I think price was going to keep going lower at the time of 1453, I buy the move contract. Now I tell myself, if the price of Bitcoin goes back up to the strike price of this contract, which is 16,500, I will exit this contract because I'm only betting on price falling. I don't want to bet on price rising. That's what I'm doing here. Then what would have happened? Well, we can actually simulate that. I'm going to show you guys how to simulate exactly that. I can actually just show you guys what happened. So pretty simply, price went back up to 16,500 at the time of 1520. So at the time of 1520, that was about here. The price of this move contract was about 105. That means that even though price went up $120 back up to the strike price of the move contract, this contract only lost $25 in value. That's it. That means that your bearish bet would not have been hurt at all. You would have lost like maybe 30 bucks. That's a massive benefit to cheap implied volatility move contracts. Is that whenever price is about $100 to $200 away from the strike price, you get these situations where you can bet on price continuing that direction. And then if price ever does go back to the strike price, you barely lose any money. That is the benefit of this. The only con of this, I would say, is it's a little bit illiquid. And then the other con is that you are technically, if you're doing this, shorting a little bit lower or going long a little bit higher than you otherwise would if you had just bought a futures contract to bet on the price falling or rising. But the massive benefit is if you day trade this and are careful, you can barely lose any money. And if price continues in that direction, which 50% of the time it probably will, you can make a lot. So let me go over one other example before closing out this video of the opposite kind of way we can do this when price rises. And then I'm going to show you guys how to simulate the contract so you can know exactly what your profit is at any minute of any hour. So if we look here, the price of Bitcoin spikes up way above 16,500. Let's say you want to buy Bitcoin, you're bullish, you want to buy a futures contract, and you just think the price will just keep rising. Let's say that incorrectly you thought when the price of Bitcoin was about 16,600 at the time of 2130, you're like, I want to buy the move contract to bet on price continuing to rise. Let's say you do that at the time of 2130. The contract price at the time of 2130 was about 117. So you would have bought at about 117, okay? To bet on price continuing to rise. Now, if price continues to rise or continued to rise, you would make $1 for every $1 movement upward. But now let's say you buy it at 113, but let's say that the price of Bitcoin goes down to 16,500. That's the underlying price of Bitcoin, and there are 0.4 days until expiration. Quick side note that you have to know. In order to get days until expiration, you divide the time left by 24 hours. So let's say that the price goes back down to 16,500 and there are 10 hours left in the contract. That would be 0.42. So that would mean that there's 0.42 days left in the contract. What would this move contract be worth? Well, in order to calculate what a move contract would be worth, you add the call and the put values, theoretical price, together to get the mark price of the move contract. So this contract would be worth about $62.50. So recall that you were betting at the price of 16,600, the price would just keep going higher, right? At the underlying price of 16,600. But a few hours later, 10 hours left in the contract, price just goes back down to 16,500. We all know that if you had bought a futures contract, you'll be down 100 bucks because price goes from 16,600 to 16,500, you lose 100 bucks. But with a move contract at this low implied volatility, you would have bought at a price of, what was it, 117, and this is now $63 with this much time left. That's a loss of, quick math, that's a loss of only about $55, $54. So instead of a $100 loss, you lose 54. Now you might say, okay, that's great and all, but what would have happened if I was lucky and right and price just skyrocketed higher? Would I not make as much as a normal futures contract? No, you would actually make the exact same. Watch this. So let's say that instead price goes up to 16,800 on high volatility, and there's this much time left on the contract. A futures contract, you would have $300 in profit. You would have $200 in profit, because if you had bought at 16,600 and price is at 16,800, you make 200 bucks. But when the price of Bitcoin was 16,600, the price of the move contract was 117. Okay, so now let's go look at how much money you would have then. Well, this move contract would be worth $300, and the profit you would get would be 300 minus 117, which is 183. So instead of making the $200, you would just make 183. So it's pretty similar. I mean, it's not that different, and it gets even more extreme. This is, 17,000. That much volatility happens. This would be worth $500. That means that you would have a profit of, what is that? 400. Did I do the math wrong? No, it would be 300. Okay, I can't do math. If you had bought at 16,600, $400, yeah, you'd be up 383 because you bought the move contract at 117. Oh my God, so much math. But essentially, what I'm trying to say is that, yeah, you would. Oh, okay. Now I've thought of it. If you had bought a futures contract, a long futures contract, at the price of 16,600, and now price is at 17K, you make $400. If you had bought the move contract at 117 when the underlying price was at 16,600, and now the underlying price is 17K, you would have made 383. Whereas with the futures contract, you would have made $400. So as you can see, the amount of money you make is not that different, but the massive benefit of this is if price goes lower to even like 16,450, you just don't lose that much money because this contract will be worth about $85. So that is a massive, massive benefit and an alpha leak that I'm going to be giving you guys with what to do with move contracts. Let's recap. The best way to do this kind of strategy because of delta is when price is about 100 to 200, about 1% away from the strike price. When that occurs, you kind of get these situations where you can bet on price continuing the trend. And if price does not continue the trend, you barely lose any money. Because if you recall here, if we had bought at about 130, I mean, you just don't lose that much money. Even on like a $200 move, you lose like 26 bucks. But if price went down 200, you'd make like 190. So these kinds of situations can make it very good to buy these move contracts when they're this cheap. So that's really something that you can do with these. Final thing I want to say, it can be tempting to, buy this contract at 130, let's say, and then you're betting on price to continue following. And then, you kind of wait for the move contract to go up because you think the price is going to, now do this. I would probably not do that. I think it's a much more disciplined approach to just treat this like a futures contract in the sense where you say, okay, the underlying price of Bitcoin is 16,400. So I'm going to buy a move contract that has that means that Bitcoin needs to expire below 16,380. Price just went up to 16,500, and this doesn't look good. I would just close out the contract and just take a small loss. The loss would be like 30, 40 bucks instead of $100 if you had actually shorted Bitcoin. That's a much more disciplined approach to this. So that is the strategy. These move contracts are dirt cheap, and this is a lot of alpha that I'm giving away. And when price begins to deviate away from the strike price, you basically get kind of a free ride on that trend. As long as you're disciplined, if price goes against you, to close out the contract. And yeah, before you do any of this, definitely research options so you can know the intricacies of how this works. And definitely don't forget that this slippage can be a little bit much. So doing this constantly is probably not a good idea. But doing this, if you think that there's going to be a lot of volatility, is probably not a terrible idea. So with that, happy trading. And yeah, I'm going to attack these move contracts.